Greetings, boys and girls. My name is Mr. Simbi, and welcome to today's accounting lesson. Here's a few things that I want you to grab before we start today's class. Make sure you have your pen, you have your calculator, as well as somewhere to write, okay? Once you have those things, I want you to sit down on your couch and relax. We're about to start our class today. Today's topic is going to be on inventory valuation. Inventory valuation. Here is what I want to talk about on inventory valuation. When we look at inventory valuation, there is a number of things that we must be very, very careful about. In this particular lesson, here are the objectives that we are going to cover. Number one, we are going to distinguish between the inventory systems. There are inventory systems that we need to distinguish, all right? Then we are going to go on to the inventory valuation methods. Also, we are going to do internal control of our inventory. And then we are going to calculate the value of our closing stock. In this particular session, I'll only concentrate on your first in, first out method, all right? And then I'm going to integrate our inventory valuation together with the financial indicators. Now, here's one thing that I want you to understand, that we have what are known as inventory systems, all right? Now, you want to know what is an inventory system. You cover this in your grade 10 and also in your grade 11. You did inventory systems. And you know there are two different types of inventory systems, all right? Which ones are they? Number one, you have what is known as the perpetual. So you have the perpetual inventory system. You have the perpetual, and you also have what is known as the periodic inventory system. Now, in your matric exam, you will still be examined on these inventory systems. If you go back in your past exam papers, you realize that they'll ask you questions such as, what are the advantages of using either the perpetual or the periodic inventory system, all right? Now, if you are explaining the perpetual inventory system, it's very easy. You understand that it is a system that is used by businesses in order for them to calculate for their cost of sales. And as you can see on the slide that I have here, this perpetual inventory system, it needs to have a computerized system. That means this is going to be capital intensive in this case. So your perpetual inventory system, you need to have a computerized system so that you can track the quantity of inventory that is available. This is now different when you compare it to your periodic inventory system. Because with the periodic inventory system, the very, very important aspect is that you will get your inventory, or you rely mostly on what is known as a physical stock count for you to determine your stock on hand, all right? So in other words, when you look at your sponsor shops, they will now be using the periodic inventory system. Why? Because for the perpetual inventory system, you need to have a computerized system. You need to have a computer as well as the software that is relevant. So you'd find this in your big retail shops. That is where they use the perpetual inventory system. Like I said earlier on, in most of your exams, they'll ask you what is the advantage of the perpetual and the disadvantage in most cases of the periodic. Here is one. Your cost of sales using the perpetual, you will calculate it at the point of sale. In other words, once you have sold your item, using the perpetual inventory system, you automatically calculate your cost of sales. But using the periodic inventory system now, you can only calculate the cost of sales at the end of the financial period, all right? So using the periodic, you get your cost of sales right at the end of the financial period. Let's go on to the next point. Using your perpetual inventory system, you are able now to determine or identify stock values at any time, all right? In other words, when you use your perpetual inventory system, you are quickly able to identify, or it is easier for you to determine your stock values from your accounting records. But when you use the periodic, you also need to understand that stock values cannot be identified easily. You need to do what is known as your stock count. What is a stock count? This is what happens when you go to the shops. At times you find they've closed down the shop and they say that they're busy doing stock taking, that is the stock count. So using the periodic inventory system, you need to do the stock count to determine the stock that you have in the business. Boys and girls, this is very important now, that when you are using the perpetual inventory system, very important, when you buy stock in the perpetual inventory system, the stock purchased will be regarded as an asset. In other words, it simply means you will debit it in your trading stock account. All right? I'll repeat again. When you use the perpetual inventory system, when you buy stock, when you buy that particular stock, what happens is you will now debit it to your trading stock account. Why? Because it will be treated as an asset. This is now different, completely different, when you use the periodic inventory system. When you use the periodic inventory system, when you purchase stock, it is treated as an expense. Therefore, we need an account, which is an expense account, so you're going to have what is known as the purchases account. So, I repeat again, boys and girls, when you use the periodic inventory system, you will record your purchases of stock in the purchases account. You debit it because using the periodic, the purchase of stock is treated as an expense. Now, later on, I'm going to touch on this. This is very important, that when you use the perpetual inventory system, you can easily determine if stock is missing. Unlike when you use the periodic, you can only determine if stock is missing at the end of the financial period. Why? Because you can only determine if stock is missing when you have done now what is known as the stock count. Unlike the perpetual, you can determine it easily. Why? Because the system is computerized. Boys and girls, I want you to come with me to the next slide. Remember, as I said earlier on, the main purpose of today's class is to teach you what is known as inventory valuation. Already you know what is inventory, the stock that we buy in order to sell. Okay? We buy stock so then we can sell them. That is our trading inventory. Now, I want you to understand that when we buy stock, we need to give it value. Okay? So that brings in the idea now of stock valuation. And therefore, to define stock valuation, we say these are the methods that are applied by an entity, which is the business, in order to validate or confirm the value. Here's our main key point, the value of stock on hand at the end of a particular financial period. Okay? We can do this using the physical stock taking. Okay? But when you use a particular inventory method, we're able to determine the value of closing stock at the end of the financial period. Now, in our matric syllabus, boys and girls, very important that you note, we have three inventory valuation methods. Number one, okay, the first one is your specific identification. Okay, very simple. The second one is your weighted average method. Weighted average method. And lastly, it is your first in, first out, preferably known as the FIFO. This is what I'm going to be concentrating on today. Today, I'm just going to be teaching on your FIFO, the first in, first out. So, let's get down with it. In my next slide now, I'm basically defining to you, boys and girls, what is this first in, first out. All right? You need to understand that when we buy stock, we sell it, then whatever remains in the business, we need to give it value. Therefore, we want to calculate the value of closing stock. Now, when we use the first in, first out method, you need to understand that stock that was bought first is the stock that will be sold first. Stock that was bought first is the one that will be sold first. Okay? Now, you also need to understand that this particular method, which is your FIFO, it is mainly appropriate for goods with a short or limited shelf life. these are goods that will not last for long. So we need to quickly sell them. So what we do is we ensure that the goods that we bought first are the goods that we sell first. Why? Because they have a limited or short shelf life. Now, you need to understand that in order for us now to control this, we need to arrange our stock in the retail market, in the supermarket that is now. We need to ensure that our stock is placed accordingly, that when customers come, they will not get the recent purchases, but they'll get the purchases that we had purchased earlier on when they buy stock from the shelves. So in other words, old stock should be in the front and the new stock should be right at the back. I'll show you what I mean by this. When you go into the shop, let's say you want to buy a bottle of milk, all right? Remember, when we buy stock, what we're going to do is we're going to put our old stock in front. So this will be our old stock here now. And our new stock will be right at the back there. This is where our new stock will be. So that when customers come, they will now take the old stock, thereby meaning whatever that was first in will be first out. So they'll take the old stock first and leave the recent purchases right at the back. Once you've understood that, I want now to explain how the first in, first out works. I'm going to introduce you, boys and girls, to a simple method which is called the bottom-up method. All right? I'm going to introduce you. You need to remember this. This is what we call the bottom-up method. This is going to make it easy whenever we are dealing with FIFO, the bottom-up method. Now, I want you to come with me to my bottles of milk. All right? Here I have 4 bottles of milk. The first one, we bought it on Monday. The second bottle, we bought it on Tuesday. The next bottle, we bought it on Wednesday. Remember, these are purchases. Then the last bottle, we bought it on Thursday. Now, when we are selling, it is very important that you understand that you can only sell what you bought first. What you purchased first is what you're going to sell first. So when customers come to the business, they want to buy milk. Which bottle of milk are they going to buy? Very correct. They will buy this first bottle. This is what we're going to sell them first when they come to our retail outlet. In other words, we will only sell this bottle, the green one, after we've sold the brown one first. First in, first out. We will sell what we bought on Monday first before we can sell what we purchased on Tuesday. Very important. Once you have understood this, the examiner will now bring you a question, and the examiner will say, we have sold goods. Already in your mind, you know, when you're selling, the goods are going to be going out of the business. All right? Then if they tell you, we have sold 3 units. All right? We have sold 3. If they tell you that we have sold 3, in your mind now, boys and girls, remember, how many units did we purchase? We purchased 4. We had purchased 4. That means if we want now to get the closing stock of our milk, how do we get it? This is what you do. If you purchased 4 and now you have sold 3, that means your closing stock, you are going to be left now with 1 bottle. Which bottle is it? Is it the brown one? Is it the green one? Is it the blue one or the orange one? This is simple now. Why? Because first in, is first out. What came in first? This one. So if we sold 3, it simply means this is already sold. If we sold 3, it means this was the second bottle to be sold. If we sold 3, remember, it means this was the third bottle to be sold. If we sold 3, that simply means of the 4 that we purchased, we are left with 1. Which one is it? The last one that we purchased. The recent one to be purchased becomes now your closing stock. So your closing stock is going to be the orange one. But here's another question, boys and girls. Why do you have to trouble yourself with going through with what we've already sold when you can only concentrate on what remains? So it simply means now I may ignore, yes, boys and girls, you may ignore all that is sold and only concentrate on what remains. So it means you come here now, you say, how many units is your closing stock? 1. And then remember, we are going to apply our bottom-up method. It simply means the last one becomes our closing stock. Which one was the last one? The one we bought on Thursday. And which one did we buy on Thursday? The orange one. So the value of our closing stock becomes the orange one. But boys and girls, you know, here we're dealing with bottles of milk. But now let's take it straight on to the figures. We want to know, how can we do this if it comes in an examination? All right? Come with me. With me here, I have activity 1, which is coming from the NCS 2018 paper. This is question number 5. And if you have the paper with you, that'd be very lovely. Boys and girls, come with me to question 5.2, and we're going to start off with 5.2.1. It says, calculate the value of closing stock on 30 June. So what the examiner wants is the value of closing stock, okay, at 30 June. 30 June becomes the end of the financial period, and then they want us to use the first in, first out method. Very simple now, all right? Let's see what information did they give us. Here's the information that they gave us. So you need to remember now, once we are calculating the value of closing stock, the bottom-up method is very, very important. I'm going to show you now. What happened is we had purchases. These are the goods that we bought now. All right? We had purchases. We had our month, which is September. We had our month, which is December. We also have the month of March. Boys and girls, don't forget the month of June. Now, they tell us that we have bought particular units. In the month of September, we bought 850 units. Here's your 850. In the month of December, we had 980. And we go on to March, we had 875. In March, we had 875. And then lastly, in the month of June, we had 450 units purchased. Once you have these, the examiner wants you to calculate the value of closing stock. And if I take you back to my question, you will realize that the value of closing stock is 496 units. And the examiner is already telling you, I don't have the unit price here. I don't have the unit price. So I want you to calculate for me the unit price over there. In other words, once you can get the unit price, it was going to be easy to get that one. But since I did not give you this one, please help me solve this problem. This is very easy. In other words, we know of all the units that we purchased, these ones, all the units that we purchased, we are now left with 496. Boys and girls, I want you to come with me. You need to understand, before you engage this particular question, there is something very important, and I want you to write this down. I want you to adjust on the issue of returns. Yes, returns, boys and girls. When you buy stock, it is not all the stock that will be satisfactory to you. Some stock will be damaged. Some stock will need to be returned back to the supplier. So what does that mean? You will not keep it in the business because you will not be able to sell it. In that particular case, what do? You return the stock back to the supplier. So you need to be very cautious when you're dealing with your FIFO. You need to look for any units which would have been returned to the supplier. In this particular case, what is the examiner saying? Returns. Very important. Then they say from June, in other words, they want us to focus on the month of June. They say in June, the purchases that we made in June, we have returned 25 units. To whom were they returned to? Definitely the supplier. What then does this mean? It therefore means here we do not have 450 anymore. Why do you say this? Because 25 units have been returned. So if I've returned 25, therefore it means I'm going to come now to my stock, which is purchased in June, and say minus. Minus what? 25. If I've subtracted 25, that simply means I don't have 450 anymore. How many, therefore, am I left with? I'm now left with 425. In other words, in June, you only have 425. This is very important. In June, you do not have 450 anymore, but in June, you only have 425 units left. When this is done, boys and girls, let us now apply our bottom-up method. Now, very simple. If we made all these purchases, some units were returned. Now, how many units do we have? 496. I want to teach you. Draw a line now. You draw a line. Then you come to the bottom. Then you say, how many units do you have at the end? You have 496 units. Brilliant. Remember what I taught you? If we have 496, that simply means these units are already sold. These ones are also sold. But this is not our problem because we have already agreed we're going to use the bottom-up method. What, therefore, does that mean? We're going to look at the last purchases. Which one is the last purchases? Our last purchase is June. All right? We'll look at the recent purchases. Boys and girls, it therefore means if I need to have 496 units at the end, 496 units at the end, therefore, I will now look at the recent purchases. And my recent purchases are 425. So you're going to come here and you're going to say 425. You now need to remember, you need to multiply this by the June unit price. And what is the June unit price? 3,040. So you're coming here and now you're saying 425 units multiplied by your 3,040. Now, grab your calculator. You are now saying 425. It's a 425 multiplied by 3,040. You get 1,292,000. 1,292,000. But remember, boys and girls, we need to have how many units? We need to have 496 units. So far, how many do we have? In the month of June, we could only get 425. Bottom up. So you look up. Let's look up. What is the month that comes after the month of June? That would be the month of March. Okay? Then the next question you ask yourself is, in the month of March, can I get the remaining number of units here? How many units are we missing? You will now say to your calculator, 496 minus 425. 496 minus 425. Therefore, you are missing 71 units. Where do you get the 71 units? From the month of March. So it's now easy, boys and girls. Let's get the unit price in March. The unit price in March is 2,930. Okay? I'll repeat. You need to get 71 units from the month of, the 71 units are coming from the month of March, and in March the unit price is 2,930. Okay? Let's punch this in your calculator. 71 multiplied by 2930. And you get 208,030. 208,030. Boys and girls, you need to add these two figures up now. You are adding your 208 plus 1,292,000. Let's punch them in the calculator. You are saying 208,030 plus 1,292,000. And once you've done that, you will get an amount which is 1,530. 1,530. Boys and girls, once you get here, once you get to these figures, it means already you have the value of your closing stock. All right? It means you have the value of your closing stock. Once you get to your 1,500,030. I want to repeat what I just did again. Remember, our key is to use the bottom-up method. What did I do? I said I need to have, how many units is my closing stock? 496. Brilliant. And then bottom up. Where do I look first? I look at the recent purchases. Recent. I look at the recent purchases. How many units were in the recent purchases? 450. But remember I told you we have returned 25. That means we are only left with 425. So I cannot get 450, but I can get only 425. Hence here, I have my 425. I say 425 units multiplied by the cost per unit. It gives me the total, which is 1,292,000. Boys and girls, remember, my closing stock is 496. 496. Therefore, in June, I only got 425. How many do I still need? 71. How do you get 71, Mr. Simbi? You say 496 minus 425, you get 71. So, remember again, bottom up. I look in the next month, which is March. In March, all the other units were sold, but 71 was not sold. So I would say 71 multiplied by the cost per unit, which is your 2,930. 2,930. Once you punch this in your calculator, boys and girls, you get your 208,030. Then you simply add this to, it gives you your value of closing stock. I would consider this to be the easiest method. Yes, this is the easiest method in inventory valuation because you're simply saying whatever came in first We sold it. It's not our problem anymore. We are only going to concentrate on what remains, what is left. And how many are left? Then you simply calculate. Boys and girls, once you have understood this, now we can fly. I want us to go back to our question. And the next question now says, this gentleman, the owner of the business, is now suspecting that there is a possibility that our suitcases are being stolen. So it says, Charles suspects that suitcases have been stolen. Already when the examiner is bringing this idea, they want you to do some particular calculations because they say he suspects that some stock has been stolen. Then they say provide a calculation. So what we need is a calculation. Boys and girls, come with me to the calculation. We want to calculate and find missing stock. Missing stock. All right? I'm going to give you a number of ways in which we can do this. All right? Number one, I'm going to use a simple way, which is to open what I call a stock account. We're going to open a stock account, but remember, this one now is in units. We're going to open a stock account, but this is in units. So already in your mind, you understand that in your stock account, it increases on the debit and it decreases on the credit. All right? Now, if we are in our question, they told us nicely that we had opening stock, and the opening stock that we had was 420. So I'm just going to put OS here to indicate opening stock. And our opening stock is 420 units. Okay? Then we did buy some units. How many units did we purchase? The examiner made it nice and easy for us. They gave it, it is 3,155. But you need to understand, some of these units were returned. So it means we had some returns here. How many units were returned? 25. We bought stock so then we can sell. That means we also need the units that were sold. How many units were sold? They said we sold 3,050. 3050. And after we sold, did we have any units left? Yes, closing stock. How many units was our closing stock? Remember, we dealt with it already. It was 496 units. Now, once you have done this, you now need to have your calculator. You now look at which side has the highest amount. You know how to do a ledger account. So you are now saying it is your 420 plus your 3,155 plus your 3,155. And you will get 3,575. You come here, it's going to be 3,575. Then we start subtracting now. All right? We'll now say minus. We subtract this one first, minus your 496, minus your 3,050. Then you say minus your 25. Then you will realize that now you are left with 4. That 4 therefore becomes your missing stock. All right? Simple. Because you have done a stock account already in your syllabus in grade 10, in grade 11. So when you come here, you already know that your stock account increases on the debit and decreases on the credit. So you simply put your stock at the beginning, you bring in your purchases, you now subtract your returns, And then you subtract the units that you sold as well as the units at the end. And then the balance becomes your missing. Okay? This is one way of doing this. Let me show you another way. Here's another way. Remember, in your exam, the examiner will give you a box. And then it has to do now with how you understand the question. You can either draw this T account in this particular box, or you can simply do this calculation, which I'm going to show you now. It simply means you now say, how many units was I having at the beginning? You were having 420, and you purchased 3,155. Of those 3,155, you returned 25, and you also sold 3,050. And don't forget, you are now left with 496. Therefore, once you do that, it will now tell you how many units are missing. Then you get 4 units are missing. This is very, very, very serious. Once stock is missing, you need to understand that when stock is missing, you need to have some internal control measures that can help you now to avoid this happening. Okay? You need to know, once the examiner brings in an idea of stock missing, in your mind as a matric student, there has to be now a question which can come as a follow-up. What then can we do to prevent this from happening? I'm going to take you through a few internal control measures. Boys and girls, you need to understand that it is possible that units can go missing. What can cause units to go missing? It can either be shoppers that come into the business, or it can be some of our employees that can be taking some of the units. So it can either be shoppers, possible, or it can be our employees that can be taking the units. So in order for us to avoid this, you need to understand that you need to have some internal control measures in place. What are these measures? Let me take you through them. Number one, you need to have a stock count regularly. You need to count your stock regularly. In other words, you need to revisit your stock room. You need to revisit your stock documents, that is your invoices, to check how much stock we purchased, how much we have sold, and how much do we still have on hand. Then you compare it with the physical stock taking. So you need to count your stock regularly and also randomly against your stock records. Very important. Once you don't do this, you'll find at the end of the year that you're missing huge amounts of stock, and that is a huge challenge. What else can you do to ensure that this does not happen? You need to order stock in smaller quantities. Okay? What is the advantage of ordering stock in smaller quantities? In most cases, when employees see that there is huge quantities of stock lying around in the storeroom, it is easy now for some stock to go missing. So you need to order small quantities, but you need to order them more frequently because we want to avoid not having enough stock for our customers. Here is another thing that you can do to improve the theft of stock. You need to improve your physical security. Now, I've realized that in most exam questions, boys and girls just say, put CCTV. No, don't say that. You need to state it correctly and say, improve physical security. For example, you install your CCTV, that is your security cameras, and also you need to have some control at the entrance. I think you've seen it when you go to major retail outlets, when you're at the door, when you want to pass and you have not paid for something, the system quickly picks it up. So you need to have that as your internal control measures. For stock not to be missing, you need also to ensure that you have an insurance cover. You need to have insurance cover that will cover you against theft, fire, and damages because anything is possible. And lastly, you need to check if the records of your stock which is received will be the same as the payments that are made for stock, as well as when stock is being delivered to the warehouse. This is very important. When stock is being delivered to the warehouse, you need to compare the physical stock delivered compared to the information on your invoices. I want us to go to the next question now. There's a very interesting question which I want you to do with me, which is 5.2.3. 5.2.3 then says, Charles is concerned about the volume of stock on hand. Okay? The volume of stock on hand should concern every business owner. Why? You should always remember that stock moves in the opposite direction with cash. All right? You need to remember this, that stock moves in the opposite direction with cash. If this is our business, all right, once stock is moving in this direction, we would then say cash is moving in the opposite direction. Once stock comes into the business, therefore it means we have a cash now outflow. Once stock comes into the business, cash is going out of the business. So you should keep this in mind. The question is saying, Charles is concerned about the volume of stock on hand. Okay? Now, the next question says now, calculate for how long his closing stock is expected to last. In most exam papers, they'll either ask you for how long is the closing stock, or they'll ask you how long is a particular number of units that they will give to you. Okay? I want you to come with me and calculate this one. We want to calculate now how long is it going to take to sell his closing stock. All right? Please remember, how many units is his closing stock? His closing stock is 496 units. So his closing stock is 496 units. We want to know how long is it going to take to sell these units. There's a very simple way which I want to deal with today. You need first to check for how many days so far have you been trading. This is key number one. For how many days have you been trading? So you need to know the number of days that you are trading for. The number of days that you are trading for in this particular year. You need to be very cautious of this, because at times we may be trading for 6 months. At times the question will say maybe we've been trading only for 8 months. Or at times they can say we've been trading for 9 months. So in this particular question, we have been trading for 12 months. So it makes it easy now. Therefore, if we've been trading for 12 months, we can now interpret it in this way. How many units did we sell in these 12 months? How many units? They told us in the question. We sold 3,050 units in 365 days. We sold 3,050 units in 365 days. So if that is what we sold, therefore, we want to know how long, in terms of days first, how long it will take us to sell the 496. So if it took us 365 days to sell 3,050, how long will it take us to sell 496? How long in days? First, I'm going to put my answer in days. How long is it going to take us to sell these units in days? Very simple. What then do you do? Please follow me. You use what we call the Cremora method. Okay? Cremora method is simple. You simply say what you want over what you have multiplied by what you have will give you what you want. I'll repeat. The Cremora method says what you want over what you have multiplied by what you have will give you what you want. So we call this the UK method. The UK method. Now, we're going to come now and say, what is it that we want? Here we want 496. 496 over what we have, which is 3,050 multiplied by 365 days. Okay? Multiplied by 365 days. Boys and girls, I want you to have a calculator. You're not going to say 496 over 3,050 multiplied by 365. Okay? And it's going to give you 59.36 days. It will give you 59.36 days. In other words, it is going to take us 59.36 days to sell our closing stock of 496 units. Okay, I'm going to show you the other way now, which is when you are using in terms of months. We want to see how long is it going to take us if we don't present the answer in days, but rather we present it in months. So the first one, number one, we did it in days, but number two, we want to present it in months now. This is easy. How do you do that? You simply go back again. How many units do you want? It is your 496 over what you sold, which is 3,050 multiplied by the number of days, which is, in this case, remember, we are not using days now. In this case, we are using months, okay? In this case, we're using months. So if we're using months, how many months are in a year? It is 12 months. Remember, we did the days one earlier on. Now we're doing the ones in months. So you use your 12 months. Grab your calculator. You now say 496 over 3,050 multiplied by your 12 months. So your answer will now be 1,95 months. All right? So you need to be very careful. The examiner will ask you either for an answer in days or an answer in months. So you need to read the instructions carefully. You need to understand the instructions very carefully. If they want it in days, you know. You want 365 days. And if they want it in months, you know. You're going to use 12 because there are 12 months in a year. Boys and girls, I want you to come with me to the next question. The next question then says, state one problem with keeping too much stock on hand and one problem with keeping insufficient stock on hand. One problem with keeping too much stock on hand and also one problem with keeping insufficient stock on hand. Here is the answers. If you keep too much stock on hand, this is what is likely to happen. If you keep too much stock on hand, it simply means you are going to have, number one, what we call liquidity problems. Okay? Remember what I said earlier on? Cash will move in the opposite direction with your inventory. Okay? So if you're keeping too much inventory in the business, it simply means you do not have cash. All right? So if you keep too much inventory, you are going to have what we call liquidity problems. Problem number two, if you keep too much stock on hand. There is a chance that some of the stock will go missing. What do I mean by that? If you keep too much stock on hand, there's a chance that some of the stock will be stolen from the warehouse. Why? Because there is too much which is on hand. So if you keep too much stock on hand, you need to understand, number one, you're going to have liquidity or cash flow problems. Number two, there's a chance that the stock will definitely go missing. And then the next part of the question then says, and one problem with keeping insufficient. Insufficient simply means less stock on hand. What could be the challenge if you keep less stock on hand? It simply means we'll end up losing our customers to other retailers because customers will come to the shop and we do not have the stock. So they'll resort to go to another retailer. That would be a challenge. So we need to ensure that we keep enough stock, because if we keep less stock, we will lose our customers to other retailers. Okay, I want you to come with me to another question which I want to do with you. You will understand so far we have calculated the value of closing stock. But in most cases, the examiner would want you to calculate what is known as cost of sales. All right? The examiner would want you to calculate cost of sales. This is very easy, especially if you're using the periodic inventory system now. So if you're using your periodic inventory system and you're calculating the cost of sales, this is how you do it. You're going to now come to information and you're now going to say, how much was my opening stock? You're going to say, opening stock. My opening stock was, it's given 913,000. 913,500. That is your opening stock. 913,500. And then remember we have purchased some units. So you're going to come here and you're now going to say, add your purchases. And remember on the purchases, we did return some goods. So you're going to say your total purchases, it is 8,460,850. But we returned some units, okay? Which units did we return? If you remember correctly, we did return some units from the month of June. How many units were they? They were 25 units from June. And in June, how much were they going for? 3,040. So you take your calculator, you now say it is your 25 multiplied by 3,040. And you will get now 76,000. 76,000. What is this 76,000? This is now your units returned. Very important here. 76,000. Boys and girls, come with me here now. You now say your 8,460,850 minus 76,000. You now have net purchases of 8 million. You have net purchases of 8,384,850. Now, once you have done this, you now say, now let me come and say minus. Minus my closing stock. Minus my closing stock. Remember, this is where we started when we were doing this question. This is where we started. We're looking for the value of closing stock. And remember, very correctly, our value was 1,500,030. Okay, so keep your calculator close to you. You're not going to say 913,500, 913,500, which is this one. Then you're going to say plus, you're adding 8 million, okay, 8,384,850. all right? And then remember now to subtract. What are you subtracting? You're subtracting your closing stock. Then you come and say minus 1,500,030. Then what you then get, which is 7 million, you get an amount which is 7,798,320. This becomes what is known as your cost of sales. All right? Boys and girls, as we round up our lesson, I want now to calculate for you the last thing. As we round off our lesson, I want to calculate for you now what is called gross profit. Okay? I want to calculate gross profit for you. Let's quickly see if we can calculate gross profit. It is easy. How do you get gross profit? Simple. You know this from your grade 10. Gross profit is sales minus your cost of sales will give you your gross profit. How do you get your sales? It's given. 3,050 units, 3,050 units multiplied by 4,200. That is our selling price per unit. So it is 3,050 multiplied by 4.2. It will give you 12,810,000. 12,810,000. And then you now subtract. What do you subtract? Yes, you're very correct. You subtract your cost of sales, which is 7,798,320. When you do this, you will now get what is known as gross profit. So you're saying 12,810,000, 12,810,000 minus 7,798,320. And you get your gross profit, which is 5,011,680. Okay? We simply said sales, your units multiplied by the selling price per unit will give you your total sales. Then you now say your total sales minus your cost of sales. Bearing in mind, we already have calculated cost of sales. So sales minus cost of sales gives you gross profit straight. Boys and girls, as I conclude and round up this lesson, it is very important that you do practice these questions over and over again. You cannot just understand this if you do not practice. You need to regularly practice over and over again. And please remember, you need to apply your bottom-up method. When it comes to FIFO, it is your bottom-up approach. And when you apply your bottom-up approach, you are looking at the last units purchased. The last units purchased are the ones that will give us the value of closing stock. Keep in mind, what is it, Mr. Simbi? Yes, the units returned. You need to remember the units returned. Here's a few pointers that I want to give you before I say goodbye. You need to remember that as you're studying, this is very important that you go and use mind the gap. Okay? You need to go and use mind the gap. This you will find from chapter number 6. Okay? So you're looking at your page 99. Boys and girls, it is very important that you also go and look at your exam guidelines for 2020. All right? And you're looking at your page 9 to page 10. I do hope that you guys today, you really did understand inventory valuation based on the first in, first out method. All right? And once more, it has been a pleasure having you in my class today. Hope to see you again next time. Cheers. Take care. Bye.